Okay, welcome everybody to episode 114. And we've got a really good show today. I think you volatility traders are really going to appreciate this one. Last week, I sort of narrowed down the volatility landscape and basically went over some basics about all the products that are on the market. There's a million of these, right? But today, we're actually going to run some numbers and see how they actually performed in real world trading in good periods and in bad periods. And I think this is really going to narrow it down for you. After today, you're going to be able to see which ones you should focus your trading on and which ones you should definitely avoid. And I'm also going to introduce a new segment today. We haven't done something like this before, but I think it'll be useful. We'll see. People can leave feedback, leave in the comments if you liked it. But I'm calling it Chart Blitz. And essentially, I'm just going to show some charts throughout the week because, things come up here and there, and I don't want to do a full segment on it. So I'm just going to rip through really quickly, just talk a couple of minutes on each one of these charts, and we'll see if that's a good segment to keep into the live streams so we can get a lot more data, but I don't have to blabber and linger. People know I can talk forever, so we're going to do the Chart Blitz. And then, of course, open Q&A. Ask me anything you want. We're going to get to the full Q&A after this, but let's actually just move on to the very first segment. Okay, like I said, there is a million volatility ETPs on the market. There's SVIX, SVXY, VXZ, VXX, UVIXY, the list goes on. And what we need to do as traders is narrow down which ones we should focus our trading on, because of course we want to get the best rate of return possible, but we also want to do it while taking on the least amount of risk. And that second part, that's something that a lot of traders sort of forget about sometimes. They chase those big gains, they try to increase the leverage factor, they calculate how much money they're going to make during good periods. But of course, we're traders, and all of us, no matter how good we are actually going to get caught with our pants down every now and then. We're going to make mistakes, and we're going to suffer drawdowns. So that's why we have to kind of look at both sides of this, the good and the bad. We're going to do the full spectrum of all of the volatility ETPs in our landscape that we covered last week, and we're going to talk about specific real-world performance. So first of all, let's do the good period, right? This is kind of the fun one. This is where everybody chases those big gains. We've actually got a really good comparison to use this time because we just recently came off one of the longest VIX futures contango streaks in history. We can see from May 9th all the way to October 14th, 109 straight days, the VIX futures were in contango. This is considered a calm, stable market, and the short volatility trade would have performed very well. So we can actually look at this table right here. I'll explain it quickly, and then I'll expand with some conclusions after that. But you can see we've got the closing price on May 9th and the closing price on October 14th. I am showing the S&P 500 as sort of a baseline here, and we can see it did very well. It made 18% during that period. I've also got the Vanguard VBanks, a 60-40 fund, so 60% stocks, 40% bonds. It is safer, it does have lower drawdowns, but it also didn't return quite as much. So these two are going to be our baseline for performance. And then I'm showing 4 of what we would call the inverse or the short volatility ETPs. Those are the ones here in green, as well as the SVOL there. And then I've also got 4 of the long volatility ETPs, and of course we're going to be shorting those. So you would go long the inverse ones or short the long ones. Both of those are short volatility positions. So even though all the red ones are technically long vol, of course you can just borrow shares on the open market and you can go ahead and short those. Now, whether you should do that or not, that's what we're going to conclude at the end of today. But starting with the SVIX, the -1 times short vol ETP, 44% return. So you can see it crushed the S&P 500. That is to be expected. The short vol trade does really well during good times. Everybody knows that. SVXY, a little bit less. SVOL, even less than that. And then the VYLD, remember, this is an interesting product because it uses point moves with the VIX futures rather than percent moves like these ones do. But given that it is point moves, it moves very slowly. And we can see that here, only an 8% return during that period. Now we can talk about shorting the long volatility ETP, starting with VXX. This is the 1 times long product. You You can see it started at $59.95. If you would have taken a short position, you would have closed it out for $36. That is a profitable trade, and it would have made 39.7%. Not bad. Now, whenever you're shorting the long products, of course, there are fees involved, and the fees can get pretty steep. In this case today, I'm using very, very reasonable fees for all of these, very low ball fees. In a practical sense, it's going to be higher than all of this, but you can see there is a little bit of bleed from the fees. So VXX at 37%. UVXY up almost 53. UVIX, the 2 times long product, this is going to make the most money. It's the most leveraged of anything in this list. Almost 65%. How fun would that have been? And then the long volatility VXZ, remember these midterm products move slower because this part of the VIX futures curve is flatter, right? The slope of this line is steeper, the slope of this line is flatter. These products move less. And you can see that here. It barely was positive. Now that's fine, it's low volume, and I don't think anybody out there is actually shorting the VXE anyway, so this is kind of a moot point, but it becomes much more important when we talk about going long. But anyway, this is our central list. Now I want to draw a few conclusions here. First of all, increasing leverage factor sees diminishing return. This is important, and we can see it here in a couple examples. So first of all, the SVIX. This is a -1, and then the SVXY is -0.5. So you could say that this is half leverage factor, and it made 24.68. Well, if you doubled the leverage factor and used the SVIX instead, would you be expecting to make 49%? That's essentially double the return. But it was actually 44. There is a loss there. There is an inefficiency, a diminishing return. And we can see the same thing on the long side. Here's the VXX at 1 times. Shorting that after the fees, you're at 37.7. Let's call it 38%. Taking a 1.5 times leveraged position, you would think it would make about 57%, right? Just mathematically. But actually, it's down to 52.8. There is a bleed there. And then the 2 times UVIX, compared to this at about 38%, this should be 76, right? But it's only 65. This is what I'm talking about with diminishing return. The more leverage you take on, you're not going to be progressively doubling and tripling the money that you make. It just doesn't work that way. It's geometric compounding of investment results, and there's always going to be diminishing return involved. The second conclusion here, shorting long volatility ETPs versus going long the short ETPs sees diminishing return as well. So for this one, we can see it very clearly. We can use the short SVIX, right? You're going long this product, you just simply buy the product, and it would have made 44% return. If you would have shorted the inverse of that, the 1 times VXX, it's only making 37.7. Now, some of that is fees, of course, but even this, 39 to 44, those two comparisons, it's not a mirror image on the other side. Buying the inverse products is better than shorting the long products. The only way to square this would be if you were daily rebalancing, or at least regularly rebalancing. The reason for that is when you short something, you can only ever make 100% return. And the better your return gets and the further away from that 100% you get, the less and less profit further shorting will give you. I mean, sure, if you wait 20 years, this is a guaranteed 100% return. All of these are. But the point is there will be diminishing returns when you're shorting the long products. The only way to combat that would be to rebalance a lot, and that's pretty annoying. You know, every day you're checking for new shares to borrow. There's fees involved. It's really annoying. Just buying the inverse products is so much simpler. The third observation is the SVXY outperforms the S&P 500. You can see here I wrote the SVXY beta factor to the S&P is 1.63. This is something that often comes up in our live streams whenever I talk about how much I like the SVXY. People say, well, it's such a watered down product, it's only half leverage. Well, the truth is it still has a beta factor well above 1 compared to the S&P. Remember, beta is a measure of the movement of one security in relation to another. So this 1.63 number means, of course, long-term averages. This is not a day-to-day absolute formula or anything. But long-term, if the S&P 500 goes up 1%, we would expect the SVXY to go up 1.63%. Now, the flip side is also true. If the S&P goes down 1%, we are expecting the SVXY, on average, to go down 1.63%. But it is a quasi-leveraged product compared to the S&P. And you can see the return is significantly more there, 18 versus almost 25. SVXY is not a watered-down product. That's only if you're looking at these crazy ones, which in a few minutes you'll understand why I'm calling them crazy. And then the last observation is just be aware when you're talking about this side of the curve here, when you're talking about going short the long volatility ETPs, You have to be aware of the 4 reasons why nobody should ever be doing this. I don't ever short the volatility ETPs directly. First, there's big fees involved because you're borrowing shares to short, and it's not cheap. This is many multiples more expensive than standard trade fees for some of the other option trades, so this is always a major headwind. Second, they're not always available to borrow. You might think you've got a great trade setup that you want to jump in on, but if there's no shares to borrow, then what does it matter? Third, you can have your shares called away on you at any time, so you're not really in control of your own trade. Plus, you should know that the time where they are most likely to get called away on you is when you least want them to be. Probably it's going to be when you're doing damage control on a trade that isn't going well, and you might want a little extra time to fix your trade, but you're not going to be able to because the shares get called away on you. And lastly, and probably the biggest reason here, when you short shares, you have unlimited loss. We're talking about volatility ETFs here. They can spike up hundreds of percent, maybe 1,500, 2,000% if you're talking about the UVIX. Why on earth would anybody trade unlimited loss when one flash crash will wipe out your portfolio? Yes, so for those 4 reasons and everything else I discussed, that's why I kind of always circle back to this SVXY, right? Of course, I don't want to talk my book today. My live streams are free for everybody. But this is why we use the SVXY within our main tactical strategy. When you factor everything combined, how much you can make, we'll talk about in a second how much you can lose, all of the risk reward involved, the SVXY is just clearly the best product. Now, I will say if you've traded many years and you're really good at managing risk, you could probably make some case for the SVIX. But for me, drawdown reduction, capital preservation, this is the primary thing that I focus on at VTS. And so SVXY just can't be beat. And for anybody who thinks you can't make a good rate of return with something that is, in air quotes, watered down, I beg to differ. But now let's go to the long side. And what we're going to do here is we're going to use this year's market crash earlier on. This was the Trump tariff nonsense that kind of went on for a period. I suspect it'll circle back a few times in the future as well, but this is from February 19th to April 8th. We've got a similar looking chart here. Closing prices February 19th, closing prices April 8th. And again, benchmarks are here. The S&P 500 actually lost 18.75%, so it was a significant market crash. As I said, the VBanks, it's a 60-40. It is safer. It's got that bond allocation as well. It was only down 8%, so that's not too bad. Now, here's where things get interesting. Of course, just buying the SVIX, if you were to just buy and hold the SVIX during that period, it would have been quite painful, losing almost 60% of your capital. SVXY being half the leverage, it is far safer. 35, I'm not saying it would have been fun, but that is far more manageable than 60. SVOL, you would think, is super safe. It's actually significantly watered down compared to SVXY. We'll circle back to this in a minute, but SVOL actually lost 33.5% during that period. And then VYLD, the point move product, it didn't actually launch until March, so it wasn't available to use the ETP prices, but we can just use the actual underlying index because remember, all volatility products, they track underlying indexes. We can just use that index and we can get the value. So it lost 16.6%. Now we'll go to the crazy long vol. This is why I call them crazy. This is why I call them insane. And this is why I say nobody should ever do this. Like I said in the intro, at some point, no matter how good you are at trading or how good you think you are, at some point you're going to get caught in the rain without an umbrella. Something in the market is going to happen and it's going to shock your trade. When that happens with the VXX, even just a 1x long product, it can be quite significant. You can see if you short it at 41, at the bottom it's at 85. Shorting has unlimited loss that can go over 100%, and you would have lost your entire investment plus a little bit more. That's just on VXX, but UVXY, of course, is much worse, down 173% on that short position. And then 2x UVIX, the full-on Widowmaker, down 252%. Now the VXX also comes into play. You can see how much safer the midterm products are compared to the front month products. This is especially true during a crisis. During stable markets, they all behave pretty normally. But during a market crash, these front month products move extremely quickly. This is what we call convexity. The price movement on these short-term VIX futures can be quite insane. But the midterm, not so bad. So now, again, we're going to do some observations. Number one, shorting long vol ETPs is far more punishing than going long the inverse ETPs. That is very, very obvious. We can see -1 times SVIX, again, not a party that I would have liked to be in, -60%, that's punishing. But the inverse of that, down 107%. This is not, oh, you're in trouble either way, but it's kind of a wash. No, when you're short the long products, you are going to pay the ultimate price. Again, the short vol trade is all about managing risk, so I would assume hopefully at some point you know how to exit to safety. If you don't, you're dead in the water, but hopefully you did. But again, this is not just a mirror on the other side. It is way worse when you're dealing with shorting the long products. Number 2, long VXZ during a crisis may double the performance of shorting the S&P directly. This is something that comes up a lot in our trading as well when people say, well, hey, you go long volatility in a crisis, why wouldn't you just short the S&P 500 directly instead? Well, we can kind of see that answer in this chart. Now, this is the inverse. This isn't quite the same thing, but you can see that going short the S&P 500, it would have actually made a decent return. But going long the VXZ would have done even better. There's even more money to be made when you're doing the long stuff. Those midterm products should not be ignored, and they make an excellent market crash ETF to hold. Number 3, this is going to hurt some feelings because SVOL is a very popular product. There's actually $750 million of assets under management. It is the second largest vol ETP. But SVOL drawdown was nearly 2 times the S&P 500, but the return was lower in the good period. This gets back to what I was saying last week, where the SVOL is kind of in no man's land as far as the ETF goes. If you know how to trade volatility and you know how to manage the risk, there's no way you would use the SVOL because it's just too watered down. Volatility traders that know what they're doing are obviously going to choose some of the other products. So SVOL is not for anybody who knows what they're doing. But it's also not for anybody who's a buy and hold person either. You can see the SVOL lost 33.5% during this period. The S&P 500 only lost 18.75. The SVOL is nearly double the risk. But during this extended contango streak, SVOL made less than the S&P 500 did. This is the no man's land of SVOL. If you know what you're doing, you're never going to use it. If you don't know what you're doing and you're going to buy and hold, the S&P 500 is better on both an absolute and a risk-adjusted basis. And for buy and hold investors, the S&P isn't even the best one anyway. There is hundreds of ETFs and stocks that are far better than SVOL for buy and hold investors. It shouldn't be on anybody's radar, unfortunately. Another SVOL, I'm actually not hacking on them. I'm just saying, like, some ETFs are good and some aren't. And SVOL, unfortunately, it's a pretty big miss. But SVOL versus SVXY is not a good risk-reward ratio either. So if we look at this one over here, if we compare these two things, I kind of expanded this here for you. You can see that the SVOL made about 30% less profit during this good period. So it's clearly not as good as the SVXY during stable markets. It's not going to make nearly as much. And that's because it's very watered down. So 30% less. The question is it significantly safer on the downside? Well, the answer is clearly no. It almost had the same drawdown as the SVXY during this bad market period. Why in the world would you trade something that's 30% worse in good times and only saves you 3.5% during bad times? Again, SVOL should be synonymous with the no man's land product. Who is this thing for? I don't know. Anyway, the bigger losses you take, the longer it will take to get back to break even. This has to do with the good old losses are more costly to a fund than gains are beneficial. If you're playing in this 30 to 40% range of drawdowns, it is within striking distance of getting back to break even if you have a good couple of months after that. But it is exponentially worse and requires an exponentially higher subsequent rate of return to get back to break even. When you're talking about these ranges, that could take a while. When you're talking about these ranges, if you ever make the trading mistake to lose 200% of your capital, and let's be real here, during COVID, these numbers are 5 or 6 times as high. Remember that. This little tariff tantrum, I mean, it wasn't fun, but it was nothing compared to what the market could throw at us. When you're dealing with losses that big, it just gets insane. And you can actually see this on charts. So if we look at the SVXY, for example, just quickly eyeballing, of course, it's not back to break even, but it did kind of get back to this level here. This is the minus 0.5 times product. But if we go to the SVIX, the full minus 1 times product, we can see it didn't get back to even this secondary down period. It's well below that. That's what drawdowns do. When you suffer these drawdowns, it takes forever to get back to break even. We can also see it just with straight up equities. This is the QQQ, the 1 times NASDAQ. You can see a point here, significantly higher point here, And then it's basically near all-time highs other than the last couple days. If we go to the QLD, the 2 times NASDAQ, there's that point. This point is pretty close to that one, and it is at all-time highs, but not by a whole lot. Now we go to the triple leveraged TQQQ. Well, you can see this point is basically at the same one as this one, and it barely broke all-time highs. This is the problem with drawdowns. When you do this and you do this, it's going to take forever to get back to break even. So don't allow yourself to dip to these low levels. I know everybody thinks they're going to be an awesome volatility trader and they're going to time everything perfectly, but the truth is, even the best, and not for nothing, I would include myself in that list. I've been doing this for 20 years. Everybody gets caught in drawdowns from time to time. And if you're in the habit of shorting these products, you are in for a world of hurt if you just get it wrong by a day or two. And of course, that is if it's a telegraph type of thing. But what happens if it's an actual flash crash? There's no avoiding that. This is the problem with having a full volatility landscape. Not all of these products are equal. There's only a few of them that are even viable for trading when you really factor in all the risk and reward. Taking a comprehensive view, again, not to talk my book, but you can see why, again, we arrive at short volatility for SVXY and long volatility for VXZ or VIXM. They're materially the same thing, just ETN versus ETF. So that's what I would say. Look, if you've been trading for multiple years and you've got a long track record of avoiding drawdowns and managing risk, then I think you could maybe make a case to dip into the SVIX range. I hate when people short the long products. I would love to just say it's just an X across the board. Don't ever do it no matter what. But again, if you've got 10 years of experience and you really had some specific reason why you had to short the VXX, don't know why you would. The inverse products are just way better in every way. But let's just say that you did. Okay, if you've got a very long track record, then fine. But basically for everybody, certainly everybody watching today, I would say you probably don't have a 10-year track record. Hopefully a couple of you do, but let's just be honest, probably not. Again, stick to the SVXY for your short vol positions, or if you're an option trader, defined risk always. And then on the long side, the VXZ. It's a watered down product. It moves slower. You can't get into too much trouble. But if the market crashes and you time that correctly, you can still double your money. It's actually an exceptionally good product as well. So now let's get to the second segment, the new segment that I talked about. Let's see if you guys appreciate this. Okay, so like I said, this new segment, Chart Blitz, this is essentially because I've got a whole bunch of data in my spreadsheets. I come across charts all the time. If I'm trolling through X, I'll see something that maybe catch my eye, but I don't want to do a full segment on it. So the point is to just rip through a few of these, choose a few every week that are kind of interesting, and just expand on them a little bit. This is a real challenge for someone like me who can really talk, but let's give it a shot. So the first one that I thought was interesting was this chart showing the average family health insurance premium in the US. This is crazy. 1999, it was $5,800. Now in 2025, it's basically $27,000. That is an increase of 365%. Now, when you factor that into incomes and whatnot, the average family income in the United States is about 80 grand. You deduct taxes from that, maybe you're down to 65, somewhere around there. These health premiums, you're talking about people spending 30 to 40% of their money just to get their health insurance. And bear in mind, this is the United States. This is the $30 trillion GDP United States. I can't believe in 2025 there isn't universal health care in the United States. What an absolute disaster the political system is to where a country this wealthy can't fix this problem for people. And of course, we could do this same analysis on housing prices, education, childcare, food costs, energy costs. We could do it across the board. It is no wonder people are having a difficult time making ends meet. But what I thought I would do, just to add a little bit of more detail here, this is the same chart, up 365%, 5,800 going to 27,000. That's insane. But what if this is just a function of pure inflation? So what I did is I used the CPI numbers and I actually calculated what would $5,800 inflation adjusted equal. So that's the blue line down here. 5,800 adjusted for inflation should have gone to about 11,129, a 92% increase. So sure, over a 26-year period, you would expect prices to go up a lot, and it should have, 92%. 365% for actual premiums, outpacing inflation by this much. This is absolutely unacceptable. You've got a situation where they are legitimately discussing whether to give the president a Nobel Prize. And there have been previous presidents who have actually gotten Nobel Prizes. What a calamity that in a country where you can't even have basic health care, basic child care, wages that track and even outpace inflation, housing that's affordable, education that doesn't cost people to go into massive debt, homelessness crisis, drug problems, people getting killed in school shootings. We're legitimately talking about which president should have a Nobel Prize? The answer is none of them. Obama, give it back. It was totally undeserved. Trump, you don't get one. The United States doesn't even cover health care. Can we please talk about the important things? I don't like to talk politics, but this chart is insane. I'm not going to high-five any politician in the Western world until some of these things get solved for people. No wonder there's a retirement crisis. All right, the second chart we're going to talk about, the Shiller PE ratio. We can see that the price right now is getting awfully close to where it was at the dot-com bust. Now, for people who don't know what this is, there's multiple names for it. It's not just Shiller PE. The most common would be the CAPE ratio. It stands for cyclically adjusted price to earnings. And essentially what this is, it's a very simple ratio. It's just the price of the S&P 500 divided by the real 10-year earnings. Real meaning it is adjusted for inflation. So you can see how a formula like this would work. If this number on the top, on the numerator, is big, and the number on the bottom, the denominator, is smaller, then that's going to lead to a larger CAPE ratio, which means the S&P 500 is overvalued. And then on the flip side, let's take something like March 9th, 2009. That was the very bottom of the financial crisis. You got a situation where back then, the previous 10-year earnings were still pretty decent at that point. But the price of the index was so low that it leaves the ratio with a small number. That means that the S&P 500 would be undervalued. Now, of course, this is happening because valuations have gotten out of control. You remember the dot-com bust, basically the reason it got so crazy was everything to do with the internet back then was getting a valuation that was far exceeding its actual revenue and earnings. And then when the market crashes, all of those dirt companies, they basically go to zero. There were a few dot-com companies that did well. They were actually good companies. A few of them survive, most of them don't, and it crashes like crazy. Well, now we're doing the same thing with AI, aren't we? We got 80% of these AI companies that aren't really making any money, but they're getting multiple billion-dollar valuations simply because they're AI related. The concept that a rising tide raises all boats. You know, NVIDIA obviously is a good company, a very important company. Taiwan Semiconductor, important company. There are a few really good ones out there, but a lot of them are just insane valuations, and it's leading to this basically phantom earnings. I'm not telling you to go sell your stocks and move to cash, but what I am saying is valuations, quantifiably speaking, are out of control right now. Now, just don't forget, out of control can lead to further out of control. As the old saying goes, markets can be irrational longer than you can remain solvent. I'm not saying a crash is imminent. This thing could go way, way higher if this AI thing keeps going. But mark my words, at some point, people are going to turn around and realize, oh wow, 80% of these companies were pure garbage. And the third chart we'll talk about, this is basically just a reminder, not only to you guys, but also to myself. Let's all remember the government is still shut down. I know, right? I totally forgot. But another thing that's interesting is this recent shutdown is actually now 38 days long, which is a record. And the previous record, of course, was already held by the first Trump administration at 34 days. Now, it seems to me, of course, there's much more moving parts and complicated, and this isn't a political statement of any kind, but it does seem to me like this is, again, over health premiums. Now, I'm no fan of the Democrats, but it does seem like their major sticking point is that they want to extend the subsidies for healthcare. Whereas the Republicans want a clean resolution, they kind of want to do other things. I'm not saying that they're looking to gut healthcare, but that does seem to be what this debate is about, and it's been going on for 38 days. Now, just to draw a parallel to the first chart, I would love it if both the Democrats and the Republicans could work together and just solve this mess. Wouldn't that be great if the richest, most influential country in the world actually had basic health care? But there we go, 38 days now. In this column here, the S&P 500 return during the shutdown, there are people out there who, when the government shuts down, they do get freaked out. They think, oh my God, the market's going to crash. Of course it's going to crash. The government is not working anymore. The whole system's going to crumble. But as we can see, it's really a non-issue most of the time. Now, I would say if the government shut down for a very quantifiable, specific reason that sounded very serious, then at that point, maybe you'd want to be cautious. But most of the time, and this time, and even including the previous record that Trump administration held, the S&P 500 basically just ignores it. But this is a government shutdown that, honestly, I had completely forgotten. It is such a non-issue, it seems, in our day-to-day lives. Let's see how long this thing can go. Okay, so like I said, the new segment Chart Blitz. Let me know if you guys are interested in something like that. I'll try to be more brief. It requires practice. Sometimes I'm actually just keep going and going, but I will try to be more brief, maybe 2 to 3 minutes for each chart, and we'll see how it goes. So leave a comment down below. See if you like that segment. And now we will get into the open Q&A right after a word from our sponsor. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with 2 main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Our portfolio is currently 3 independent strategies with low correlation to the stock market and to each other. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so yeah, like I said, hopefully that chart thing will go pretty well. I've got a folder on my computer that just has hundreds and hundreds of charts that I always kind of think, oh, that would make a great video or a great live stream topic, and I dump it into this folder, and then I just never circle back to it because I do have what I have, the structure of the most important videos and most important topics to get to. And just hundreds of kind of cool, interesting things just go under the radar. So I think that might be a way to slowly bleed them out, 3 or 4 a week until I can get a handle on that folder of mine. So let me know. I'm going to do it for a few weeks and just see what happens. And what I might even start doing is, packaging some of these segments and reposting them just as standalone videos, just in case, it's buried deep in a live stream. Maybe people missed it and whatnot. So it's one thing that I've tried to never do, to be perfectly honest. But when you look on YouTube, you see people who do a podcast or a video cast in this case, they tend to just chop them up as well and then just post those. So it's one live stream. And then on the same channel, like right next to each other, there's 4 or 5 individual segments as well. I've never done that. I've never posted any of my individual segments on the the main YouTube channel. But we'll see. Everybody else does it, and everybody else seems to be better at YouTube than I am. So maybe there's something to that. But yeah, so there's a few questions here. One thing that I did, I can just show you very briefly here. What am I looking at here? One interesting thing about our email today is that we actually cycled out of all of our positions, which rarely happens. As I mentioned in the email, I will talk Monday and I'll show the data on how rarely this actually happens. But all 3 of our official strategies rotated out into safety today. And then, of course, our optional Bitcoin strategy, which I'm sure a lot of people are trading it, but with whatever allocation you feel is necessary. That one as well. So all 4 in the same day, essentially. So one of the things that I did was, just in case there aren't enough questions to fill a live stream, which would be rare because there's usually too many, but I can actually just rip through and execute those trades live if people want to actually see that. So I'll jump into some of these questions in just a second. And then if we run out of questions and we have a little bit more time, maybe I'll do that. Maybe I won't. Maybe I'll make a standalone video, because a lot of people get intimidated and think, oh my God, there's 4 trades today. You could literally do that in 2 minutes. It's very easy. And I wanted to show people how quickly it can actually be done. The other thing I really, just give me 1 second here, I do have to cover this as well, if we go to the YouTube channel, I just want to make a note to everybody. I made a community post asking people to submit questions for today's live stream. And there was actually 4 questions, I think 4, last I checked. They're all great questions. One of the issues that I kind of immediately realized was if I start answering prepared, like submitted questions, there's not going to be any time at all for the live questions. So I think what I'm actually going to do, and I had this idea, just a few hours ago when I was out running, so it's not fully fleshed out here, but hear me out. I was thinking that maybe I could have just a running open Q&A type of thing where people can submit, and then I would just go ahead and make a private video answering those questions. Very similar to if it was asked in a live stream, but I would just turn on the camera, read the question, answer the question, and then I would take that and I would cut it and put it on the Clips channel. So if people don't know that, we also have a little Clips channel. I haven't promoted it really at all, but I've been slowly bleeding out some clips. So there's 112. These are just very short videos. They're usually about 2 to 3 minutes, something like that. And there's a lot of these. And I could actually just answer people's questions and then basically submit them to the Clips channel, and people could get a much better answer to their questions. So something I thought when I was out on my long run, that might be a pretty cool thing. And people, of course, hopefully they'll forgive me. Sometimes it might take a few days for me to get around to it. I do have top priority getting the VTS options community back up and running. And then I also do want to do a video a week, just continuing on with the lessons and the courses that we're building. So that would be sort of third priority. But I think that would be pretty cool that you could actually submit questions and get a video made for your question. So we will see. All right. Been talking for a lot, and that's speed talking. Let's take a deep breath, calm down a bit here. I tend to talk fast and think fast, so I got to cool down. It's also 1:30 at night. I just had a killer day today. I had such a productive day. It was one of those that just it's 1:30 at night right now, or in the morning, I guess. I just nonstop, every single minute of the day was filled. I had a fantastic day, so I'm in a good mood. Here we go. Can you provide P&L for open and closing positions in your daily emails? So there's actually a specific reason why I don't do this. So if you'll notice the emails, all I do is I give trade signals for each strategy, right? I try to make it as obvious as possible. And each strategy today, there is a new trade. So sell the SPY, buy the IYR, pretty simple stuff, sell the IBIT, buy gold. But there's nowhere that I actually post the prices. And there's a couple of reasons for this. First of all, I take the trades live. So our performance that you see on the website is coming from my live fill prices in that account, this public toss account that we have. I have a long-term portfolio that I don't show, but that public toss account, usually there's a little bit of money in there, and that's where it's all coming from, based on a $25,000 account. So it's all live trading. When I send my email, I haven't taken the trades officially yet, so there's nothing to post the same day. The best I could do for you would be somehow to come back the next day and show you the prices. There is a reason I don't do that, though. I used to. And I'll tell you, it was an insane burden on my email. What ends up happening is, let's say you exited the SPY today and you got a certain price, whatever the price may be. Remember, you've got 5 hours to execute your prices after I send the email. You've got 5 hours left of trading. So you're going to get a different price than I did. Hopefully it's going to be close, but 5 hours, a lot can happen in the market, right? It's just intraday noise. We all deal with it. But what ends up happening is, let's just say for the sake of argument, 50% of the community gets a better price than I did, and 50% gets a worse price. What happened when I used to post the prices is a lot of the people who got a worse price are going to email me the next day and say, well, what's going on? Did I do something wrong? How can I fix this? I don't want to get bad prices. So it's called anchoring bias. When you give somebody a price to look at and you flash it in front of their face, they have a very difficult time mentally getting anything other than that or better. And so it's actually a real nightmare just for me logistically in, answering emails. It's a real problem if I tell people every single time when I executed this and here's the price I got. Half the people will be just happy that they got a better price than me, but they're not going to email. They're not going to email and say, hey, I did better than you, haha. They're just going to go on about their day. It's the people that got a worse price just based on random noise of fill prices. They're the ones that are going to be disappointed in emails. So just to cut down on my email burden, I quite quickly abandoned that policy. And now I just say, look, it's all based on live fills. Every now and then I'll make a video showing people how I do that. There's actually a couple on the YouTube channel that you can just, it's very boring. They get low views, but I just go through it and I just show that it comes from my Schwab account, my TOS account, and that it is what it is. Just do the best you can. The email goes out roughly, let's say 11:30 in the morning. You've got 5 hours. I have no data that shows any time of day is better than any other. 12 noon, who knows? That's not better than 3 p.m. Like end of day versus noon versus 2 in the afternoon. I have no data that shows that we should be targeting any specific time. If I did, if somebody had that type of specific data, we'd all be millionaires, right? It's intraday noise. So just do the best you can. Okay. Thank you for the amazing job with daily emails. Awesome. Yeah. Thanks for the compliment. Always on time. Yep. I was late once. Not my fault. Internet problems. I travel an awful lot. But yeah, I am that type of person. I eat the same thing every day. I do the same thing every day. Everything is on a schedule. Driving my wife crazy, but that is the brain that I was born with. Yeah, live streams are back. Here we are. So it might take a little while for people to realize that we are back. I've noticed that the number of people tuning in is a little bit lower, but hopefully by Christmas we're back. I did take a long break, to do my teeth and whatnot. So that was a problem. Have your gums already healed after the difficult reconstruction? Was it expensive? So aside from, my tongue can feel in the back of my tooth that some major work was done back there. Remember, they had to cut the gums off and then shave the bone down. And so it feels like there's a big hole there. And then the teeth, this one, I basically lost my front tooth for anybody who doesn't know. And it was really difficult to rebuild because the whole tooth fell out. There was no base left. So it was actually pretty tough. And the back of this tooth, it's just, I can feel how long it is. But yeah, it's a mess in the back, but it looks great from the front. And it was $12,000. So I said he did a fantastic job, and he did. He better have for that kind of money. Yeah, that's where we are. Dentist work, like I showed with the healthcare premiums. Money goes out so fast, we all kind of wonder where it all goes. All right, I was thinking putting put fly end of November expiry +1 645, -3 615, +2 at 600. So not so much a put fly as more of like a ratio spread. And you're talking about the SPY, I would assume. It's somewhere around 6. It's in the 6s. I don't know. I would assume you're talking about the SPY. If it pins at max profit, it's 10 times PNR. So your center at around 615. Isn't that a pretty significant drop from here? If you are talking about the SPY, what are we at? 615. Yeah, it could get there for sure. You could maybe try to make a case that the market is overvalued. It's been doing well for so long. I showed the contango chart, 109 straight days in contango. That happened basically this whole stretch. Could it go down to, you're talking about somewhere around there? Could it go down there? Sure, it could. I have to apologize. I don't really know what you mean though by the 3-2-1. Put fly. Usually it's just, 1-2-1 equivalent. But yeah, if you're doing a broken wing butterfly or something like that, it's worth a shot. Like you said, if max profit 10 times, nothing wrong with that. I wouldn't put too much money in it because you got to remember that the options market is very efficient. And anytime you're getting premiums that would allow you to get 10 times your money, the probability of that trade actually hitting is extremely low. That's why it pays off so much. So I wouldn't put much money in that. But there's nothing wrong with throwing 1% of your capital. Anytime I'm option trading, sometimes iron condors get to about 3%, But most of the time, if I'm doing butterflies or broken wing or calendars, whatever I'm doing, it's typically either 0.5 or 1% of my capital. I would say if you want to do a 1% trade, I see nothing wrong with that. And hopefully it hits. We moved full on to safety. So do I care if the S&P goes down another 10%? No, we're probably sitting pretty good if that happens. So to be honest, I wouldn't mind a little bit of a pullback. It's always healthy for the market to have a nice run, make our money, and then see the market take a breather, pull back 10 or 15%. That would be great, and then get ready for the next leg up. Okay. Yeah, I should have read forward. Nothing wrong with this at all. Some type of broken wing trade pinned at 615. It could totally hit. Probability is quite low. So again, keep your allocation size small. All right, I'm relatively new here. What if, okay, I don't like where you're going with this. You short UVIX and let's find, okay, rebalance daily. No problem there. Pull out when your indicators say to rotate into IAU. So my guess is, this is a very simple question. You are asking, can you replace the SVXY with a short UVIX position, rebalance daily? My answer is, of course, you can do anything you want, right? I'm only presenting my portfolio in the way that I personally have all my investable capital in. This plus my VTS option strategies, those 5 or 6, that is my portfolio. I'm not presenting things to look cool here to try to, get subscribers. This is where my capital is. I have my money in SVXY, and I wouldn't even use the SVIX, which is only 1 times. You're talking about the UVIX, which is a 2 times. That's 4 times leveraged compared to the SVXY that I'm using. I mean, obviously for me, it's a no. It's a hard no. And the reason for that is that strategy, with this strategy, I am trying to balance let's get a picture here, the risk-reward ratio. And this strategy had a drawdown of around 30% with an annual return of around 30%. It's a very good ratio, right? This is my VTS performance score is a metric that I created myself. There's a video online on the YouTube channel. Anything at 1 or over is an exceptional ratio. That basically means that the rate of return is equivalent to the average of the 3 largest drawdowns. Whereas if you look at something like the SPY, makes 10% long term, but the average of the 3 largest drawdowns is in the 30s, so in the 40s if you include the financial crisis. So, I'm focused on the ratio, but there will be drawdowns even using the SVXY, like down 30% using the 0.5. What do you think it's going to go to if you use the 2 times UVIX? It's going to be insane. It's probably going to be totally untenable, and you're going to pull the plug at the worst time. That's what you want to avoid when you're trading, is suffering drawdowns that make you pull the plug. You have to understand that some of the best market periods happen right after the biggest market crashes. If you look at the financial crisis, it can go down a lot. It went down 56% in 2008. But when it finally bottomed in 2009, it's a nice V bottom and it bounces. COVID was down 35% on the S&P 500. But when it bounced strongly. What happens if it's down 25, 30, and then you pull the plug? Well, you miss that whole bounce, and now you're not getting your 10% annual. You're getting way lower than that. This is why buy and hold investors eventually are always disappointed. Everybody on Twitter says just buy and hold. You can't beat the market. Don't even bother. Don't mess with it. Just do this and hold. You can't. You can't watch your money disintegrate in front of your eyes and just keep going. It just doesn't work that way. The only people that say that are people who have never traded through a crisis. It doesn't work that way. Emotionally, when you see your capital bleeding, you're going to want to get in there and start messing with things. That's just what happens. So if you're going to be using the 2 times UVIX, you're going to very quickly be messing around with things. It's just a terrible idea. So hard no for me. But like I said, can you? Sure. Just don't come blaming me when you're in a drawdown that's on my end very manageable and reasonable. On your end in your account, totally making you look for the exit. That's my guess. That's probably what's going to happen. 450 or 650 in the ACA healthcare marketplace for catastrophic. Yeah. Yeah, I don't like the politics talk. I mean, I was a little bit harsh there, but I think it's definitely warranted. But yeah, the truth is that this government shutdown, it's significant, right? If it goes the wrong way, and let's say the Democrats just give in and they say, oh, let's just let these, subsidies expire, it's going to be a real problem for a lot of people. It won't be a problem. I'm kind of being a dick when I say this, but I'm not American. But it wouldn't be a problem maybe for you and I, maybe for people who have a little bit of extra capital at the end of the month. It wouldn't be a problem. But you have to understand that, half of Americans live paycheck to paycheck, more or less. You're talking about a devastating, it might sound like, it's only 500 difference. That can make or break a budget for millions of people, tens of millions of people. So this is a big deal. And like I said before, I'm not being harsh at all. These politicians are making billions of dollars for themselves. Is it too much to ask that they maybe kick a little back to the people that actually pay the tax money? I mean, is that too much to ask? Universal health care. Donald Trump skates away with $5 billion, personal wealth. His family has contracts all over the planet now. Awesome. You do you. But is it possible that you maybe in your 4 years that you're there do something good for the people as well, not just make a bunch of money for the billionaires and just walk into the sunset? I mean, is that too much to ask? So, yeah, I hope that they just do the right thing. Doesn't mean Trump and his boys can't continue making money and manipulating the market. They're still going to do that, and all the power to them. He won the presidency. You go for it. Presidents do that. They get rich. Trump's going to get rich. Fine. But can housing be a little bit more affordable while you're getting rich? I mean, is that okay? Can you maybe have universal health care? The U.S. can afford it easily. Can you maybe fix a few roads and build a train station once in a while? Is that too much to ask? So I don't know. I'm at the end of my rope with people who are actually in favor of any single politician. Like, they're all terrible. Can we just admit the truth? They're all unbelievably bad, and none of them have done any morsel of good in the 4 years that they've been there. It's just, yeah, I got to calm down. I hate the state of the world. There's so much money sloshing around and they can't figure out. Could you imagine? Sorry, I'll just keep on going with this rant. Could you imagine being so staggeringly wealthy? You have a personal income that is just an obscene amount of money, and you can't even balance your checkbook. Like, you can't make it work. At the end of the month, you don't know where the money went, but for some reason you don't have enough food. That's kind of the equivalent of what's going on here. The United States GDP is $30 trillion. And where does it all go? Nobody can account for any of it. We just know that it goes to the top 1%. I guess everybody's fine with that. I guess, half the country plus a few percent voted for Trump. Okay. Maybe 1% of those people, their lives are getting better. 49% of the people that voted for this guy, their lives are getting worse. And it's the same thing. I mean, I'm an equal opportunity offender. It's the same thing under Biden. Apparently 85 million people voted for him. But 84 million of those people were far worse off at the end of the 4 years, and 1% of them were better off. So can we just actually try to fix things? And this government shutdown, I mean, it's a small win, but you've got to give those subsidies to the people that are counting on it, because, there's some people watching my live stream. If you're a vol trader, if you're an investor, probably does mean you've got a little bit of extra money at the end of the month. There's a lot of Americans who don't. So this is about them, and yeah, it's a problem. It's a big problem. Okay, unfortunately, will happen. I am fortunate being a boomer. I'm trying to build a decent inheritance for my kids. I might have missed something, but that's a good thing. That's good. My thoughts on that, I mean, everything would be just personalized to me, but I'm actually trying to get my mom to spend every dollar she has. So the idea of an inheritance, I always felt like do you. I mean, that's a wonderful thing to want to actually give and provide something to your children. But I always feel like the life lessons to make your children successful on their own, X money and giving them financial assistance, that's the real benefit, right? Hopefully, I think the goal would be to get to the point where you're late stage in your life and you're comfortable knowing that your kids have built their own careers and they have their own money and they don't want yours. That would be great. And then you could go have fun and spend all your money, go buy a sports car or whatever you want to do. I am new. That's okay. New people can join. I assume I'm missing something. You write sale X, buy this. I follow you 1 month. I buy X as you say, but when I sell it, I am in significant loss always. So, no, not true. But how am I going to answer this question? What am I doing wrong? I don't think you're doing anything wrong. I use my broker to do it. I buy exactly what you say and selling it when you write. Always I'm in loss. What am I understanding wrong? If you joined just in the last month, you probably had 2 weeks of good trades to finish out October, which was a profitable month. And then the last week in November has not been good. The market's down 4%. We use leverage, so we're probably down about 5, something like that. Yeah, it might feel that way. But no, that's not the case. When you follow the emails, that's really all you're doing. So let's just take defensive rotation, for example. Today, you were in QLD. That, because I didn't sell the full position, so you can see the QLD was down a little bit of money, right? So this was opened a while back, and it was down only a little bit of money. And so to say that you're down a lot always, I'm not really sure what you're getting at. But no, you just want to, like, I can't tell you to follow my trades. That would be, soliciting basically investing advice. But my portfolio just takes the signals when they come. Some of them are winners, some of them are losers. And if you wanted, like, I have no percentages. I guess I could go back and calculate, but I don't really care. But let's just say 45% of your trades are going to be losers and 55 will be winners, something like that. So if we're going through a rough patch like the last couple of weeks, it might feel like, oh my God, every time I'm in this and out that, I'm losing money. That's because you are. I mean, you are actually losing money the last couple of weeks. But it's, I don't want to be that guy that says, hey, it's no big deal, because financial losses are obviously, it's a problem. But I can only say for me, I love the performance and I'm going to stay the course. So whatever the signals come on Monday that I send out in the email, I can't tell you to follow them, but I am going to be following them. Whatever they are, I'm going to follow them diligently, like a robot, like a cyborg, because it works. Long term, it works. That's all I can really say. I kind of have to dance around this a little bit because I can't directly tell you what to do with your money. But yeah, those are my thoughts. What is an example of a long volatility strategy you had recently? I don't trade anything that I would say is a pure long volatility strategy. I have strategies that lean long volatility, like, for example, my earnings plays. The way that I trade earnings is sort of flipped. A lot of people sell it as it's going into earnings. They'll sell a straddle, for example. They'll wait for the earnings call, expecting volatility to come down, and then they'll sell it after. I actually do the opposite. Maybe a week to 10 days before the earnings, I'll buy a long straddle or a calendar or something, and I will expect the volatility to increase as it's going to the announcement. And then right before the announcement, I will sell and take my profit. Those are long volatility trades, right? They're Vega positive, long bias trades. But it's not specifically a long vol strategy. It's just a strategy where the structure of the trades I take happen to be long Vega. capitalizing on hopefully some big market movement during that time, but also a nice little bump in an increased volatility. I don't know if that's what you're getting at. The only other thing that I could say is I do, which would be the right spreadsheet, I do trade long volatility. You know, this might look like it's some type of balance here, but it's actually just a sliver. It's only about 2.5% of the time I'm in long volatility, only during the most extreme market crashes. That's the only time. Now, you might think, oh, that's nothing. It never exercises. But the truth is, when the market crashes, it will stay in that top 98th percentile from 98 to 100 for an extended period of time. So it's not like you're just in and out in one day. It can stay allocated to long vol in that top 2 percentiles for weeks on end if it's a real crisis. And so that's the only time I actually go pure long volatility. Other than that, I have a lot of neutral stuff. I have a lot of, like I said, I do take trades that lean long Vega, but you know, long volatility it's not always a loser's position, but it's a real tough trade. You can't time it because every trend is different. You might think, oh, volatility's declined so much, it's got to spike eventually, right? The market's been so calm for so long, it has to crash any day now. I'm just going to buy long vol. Okay, well, I mean, good luck. Hopefully that works, but as we've seen, the market can stay stable for months on end, and you can just, long vol is an insurance product. It's really no different than a decaying put option. So yeah, you're going to bleed capital. Okay. With respect trades and reporting, why not standardize trade reports using closing prices? That way everyone can be on the same page with respect results and there would be no issue trading ahead. I like where your head's at. We could all benchmark our time of day trades with, against, and consistent set of end of day prices. So you are correct. You are absolutely correct. So just to give you a little VTS history, from 2012, when I officially launched, up until 2019, I used end of day prices. Now, I personally used to trade a lot of end of day anyway, right? I lived in Taiwan basically that whole time. This was before I moved around the world and I was a Dubai resident. I was in Taiwan, and right now it's 2 a.m. for me. So I was just kind of in this pattern of being, watching the markets at very strange times. So I used to use a lot of market on close orders, and I would just execute my trades market on close. And then around 2019, actually about 2018, I started doing YouTube, started making videos and doing live streams and whatnot. Or maybe lives didn't start then, but I was doing a lot of videos. And I just had a ton of people doing the opposite of you now. I don't want to use the word complaining, but saying, oh, this guy's not even live trading. His performance is coming from end of day prices. This guy's, some type of fraud. He's not even exercising these trades, right? It's YouTube, right? People say dumb shit on YouTube. But anyway, that's what happened. So I said, you know what? Let's try it for a year. Let's go live fill prices. I'll have the full history of executed prices, and we'll give that a shot. And I did that in 2020, I think is when we started, and it worked fine. People kind of stopped complaining, I made a couple of videos saying, okay, we don't use end of day prices anymore. We use this, and it worked fine. And I have noticed just in the last few months, there's been a few people who are sort of leaning the end of day, standardized, everybody gets the same closing price. Even though we're all executing trades during the day, why not report results using the end of day that's exactly the same and everybody can go see? I kind of agree with you. I think that I can make a case for either. It just so happens that we've tried both of them. So 2012 to 2019, maybe 7 years, and then 7 years. So it's been about equal amount of time that we used closing prices for the first half and now live fill prices for the last half. Which is better? I don't know. You got to do one. And if I do one, then people are going to, hey, why don't you do the other? And if I do that one, people are going to say the other way. I can make a case for either. So it's not going to matter, really. I mean, your price is your price. Nothing I do on my end is going to change that for you, unfortunately. I wish I could give you the best ones, but we're all subject to intraday noise. And I have no idea. Like it's what, 2 o'clock? That's New York time as well. So there's still a couple hours. I don't know. Is the market going to recover? Like I exited all my positions just a little bit after the email. And I believe the market was down 1% when I did that. So it's 0.87. But you can imagine, like, the market could easily turn green towards the end of the day, right? That happens, I'm not going to say a lot, but it definitely can happen. Or it could fall off a cliff and it could be 2% down. I don't know. I just know that for me, I closed out my trades. You know, you can see I executed them all. These are the trades that we did. We did QLD, SPY, SVXY, and then the Bitcoin strategy, IBIT. And then I just bought these. It couldn't be easier to do this and to track it in a live account, right? Like I always say, this is our TOS public account. This is our VTS account. And it makes sense to me. But then as well, yeah, I can totally make a case for doing end of day closing prices as well. It's not hard to make that case either. So I don't know, flip a coin. Doesn't matter to me. It's all the same to me. Here we go. We do have free healthcare. It's called being broke and going to the doctor anyway. Why do you think insurance is so high? I think there is some of that. And honestly, that's kind of what it should be, except it shouldn't have to be under the table. It should just be, yeah, you should just go to the doctor and get fixed. Now, I'm Canadian. I don't live in Canada. I haven't lived in Canada in 20 years. But we have what we would call universal free healthcare. However, it's obviously riddled with problems as well. I mean, free healthcare in a country that doesn't care about its citizens, like Canada, like the US, like the UK. I mean, I'm sorry to say, if you think your politicians care about you, you have lost the plot. They do not. Okay. So Canada, they don't care about us either. And we have free healthcare. But that only extends to if you want to wait 8 months and if you don't ever want to look at a specialist and if you don't have anything mandatory that needs doing. My sister, for example, needs both her knees rebuilt. She has to pay $50,000 out of her own pocket because she doesn't want to wait 18 months to get these things done. So is it free healthcare? I guess technically, like on paper and on the news, they can say, we can laugh at Americans with, you know, they don't even have universal healthcare. Look at us in Canada. We got free healthcare. In the UK, they talk about they have free healthcare. Do you? I mean, do you? Kind of, maybe, but yeah, it's all crap. It's all unbelievably bare bones and totally unacceptable in rich Western countries to have to even have this discussion is ludicrous. You know, like I said, it's like being like a billionaire and not being able to afford going to Costco. You know, where did my money go? That's how we just live in the Western countries. Okay, what do you think about New York City new head? I assume the new mayor. Honestly, I'm going to have to punt. I have heard all the negative rhetoric that you have. I have heard the outrage of the socialist / communist / end of New York City as we know it. I've heard all that as well. Unfortunately, I have not done any research of my own. And in this social media age, it is very possible that everything that's been said about the guy is either, half-truths or maybe just outright lies. I don't know. It could all be dead on as well, and this could be the end of New York City, which it's a shame because I love New York. I've always said it's my favorite city in the world. I don't know. I don't want to say I don't care, but it's just, what am I going to do about it? And also, I got other things to worry about. I have other things to pay attention to. They voted. I hope they know what they're doing. I hope that they were, informed voters and made a good decision because New York is one of the best cities in the world. And it's important. It's important to the U.S. and it's important to the world. And hopefully it's going to go in a better direction. However, I'm not confident in that because politicians do politician things. I'm sure that guy's going to get rich, and I'm sure he's not going to give anything of value to anybody else in his time there. That's just odds on. That's probably what's going to happen. That's what politicians do. Excellent communication regarding U.S. politics. They enter with a small net worth and on average leave up 20 million. Yeah, 20 million. Those are Obama numbers. It's like in Wolf of Wall Street. You got to pump that numbers up. Those are rookie numbers. What Trump and his boys are doing, it's disgusting. And I wouldn't be so hard on Trump if, like I said, you want to make $5 billion for you and your family. Okay, the money's there. I guess you should take it, right? If there's a $5 billion bag of money on the table and I'm allowed to just kind of take it, it would be very hard for me to not take it as well. So I understand that Trump is going to fleece the U.S. Treasury for everything that it's worth. I get it. I'm not naive. But like I said, it would be nice if we could point to some things that like, okay, your family's going to be living in gold mansions for the rest of their lives, but you did provide this and this and that. So there you go. I know it's early on, but it's not like this is new. We've seen a full term from him already. We've seen Biden, we've seen Obama, we've seen Bush, we've seen Clinton. Boy, I mean, you could count on less than one hand the number of actual good things that any one of those people, all combined since 1980, have done positive for the people. It's just a slow, steady decline of nothing gets done. It's just a worse version of the previous one. Healthcare is worse now than it was 10 years ago, and it'll be worse in 10 years than it is today. Housing is more unaffordable today than it's ever been, and just wait 10 years, you won't even believe it. Like, this is just the world we accept and live in. So I'm going to be consistent with what I was consistent, hacking on Biden and calling him a loser and saying he was a terrible president because he was. I'm going to say the same thing that I say about Obama. Terrible, nothing got done because it was true. I mean, I had high hopes, but it's true. And I'm going to say the same thing about Trump. I'll be fair if he shocks me and they're like, oh, damn, he actually fixed healthcare. Look at that. He fixed the tax code. Unbelievable. Finally, somebody did it. Look at that. Housing is finally coming down. Yeah, took a real estate developer to do it. I'll be fair if it happens. But what I've seen so far, yeah, I know what the game they're playing is. And it's not for us. They don't invite us to their fancy parties. They don't invite us into the room when they're deciding when they're going to tank the market and make another $1 billion. I'm not invited to those meetings. So I have a right to be angry. And I'm not even American. I would be livid if I saw what was going on and I was a voting, tax-paying American. Crazy. But that whole long rant, yeah. Politicians are there for one reason only, to enrich themselves, and anybody who thinks otherwise, you have lost the plot. You need to pay more attention because you're having the wool pulled over your eyes. It's a hard truth because people voted for what they thought would change the country, and it just never happens, does it? It just never happens. So I don't know. And honestly, there's no other solution. Like, the idea that we actually even live in democracies is crazy. Both parties are exactly the same. If Kamala Harris won, do you honestly think healthcare would have been improved? Not a chance. You think housing was, if only Kamala got in, housing would now be affordable. Student debt wouldn't be a problem. Homelessness would have been cleaned up under Kamala Harris. Really? People think that? No. Nothing would have been better. It's just, we're handcuffed. They tell you have to vote, right? You have to vote. You're wasting your vote. If everybody, you got to do your part. Democracy. And then you do. Okay. Well, here's the 5 things that I voted for. When are they getting done? Never. That's the answer. Never. So, well, as I always say, make money, work hard, take care of your family, stack your own money, and just understand that nobody's coming to save any of us. We have to do it ourselves, especially if you're a man, which 99% of my community are men. I don't know why. I don't speak specifically, just guy talk or anything. I don't know why women don't follow me, but they don't. But us men, we know since we hit puberty that we're going this alone. Nobody's coming to save us. The government is not going to come and help us. So we've got to do all of this ourselves. And I try to do my part. I try to help people make money investing. And that is it. That is all any of us can do. So we will leave it there. That was a healthy number of rants today. We'll try to reduce it a little bit next time. But yeah, it's 2:15. I crushed it today. I had a great day. And I'm going to bed. I'm tired. See you next week.